Hello, good evening. Welcome to Business Live. Coming up in this edition, Finance Minister announces there will be no need for supplementary budget as government reviews its macro fiscal targets to align with conditions set by the International Monetary Fund. We have details of these and many others coming your way all in a moment. Please stay. Thanks so much for your company. I am Pius Kojo-Baka. Let's now focus on our big story for the day. And Finance Minister Ofori Atta has said that government will not need any supplementary budget for the 2023 budget approved last year. This is the third time in a row that the minister has not requested for a supplementary budget. Delivering the media budget review today, he explained that despite a shortfall in oil revenues due to changes in global prices, there has been an increase in non-oil revenue collection in the past 6 months.
Mr. Speaker, the PCPEC government program is implementing, with the support of the IMF ECF facility, requires strong fiscal consolidation. This will enable us quickly re-establish macroeconomic stability and debt sustainability. These are necessary preconditions for long-term economic growth, job creation, and rapid transformation. A key pillar of the PCPEC is the focus on inclusive growth. Our renewed push for growth is informed by the usual experience that fiscal consolidation tends to have negative impact on growth. For the medium term, we are targeting revised economic growth rates of 1.5%, 2.8%, and 4.7% for 2025. Mr. Speaker, we need to be deliberate and strategic in our actions if we are to exceed our post-COVID-19 strong economic growth, which averaged 7% compared to the 4.5% and 2.6% in lower middle income countries and sub-Saharan Africa. With the economy showing signs of stabilization, government intends to pursue a growth agenda that is fully aligned with the 2028 timeline for returning to a path of debt sustainability. Mr. Speaker, given the limited fiscal space as well as our determination not to accumulate new arrears, our growth agenda will be mainly financed from domestic and external private sector investments, as well as a rationalization of ongoing programs. The approach is to prioritize existing programs that are critical for growth and can be implemented to deliver quick results without huge demands on the available budgetary resources. Ultimately, we will aggressively encourage the private sector under the Ghana Mutual Prosperity Dialogue framework to promote shared growth anchored on job creation, food security, exports, and import substitution. Towards this objective, government expects to finalize a growth strategy in August 2023, an enhanced growth strategy that is. Mr. Speaker, the key elements of the enhanced growth strategy include accelerating, scaling up and aggregation in agriculture and value addition for key staples such as rice, poultry, maize, soya, and tomatoes, supporting industrial parks and economic zones that promote innovation and positive spillovers and efficiency for key sectors such as the automotive, pharmaceutical, technology, textiles, and garment industry, promoting tourism to attract international and domestic tourists to boost incomes and create jobs, deepening the digitalization of public service to promote efficiency in service delivery and protecting the public purse, expanding housing delivery programs to improve access to jobs and accommodation, and deepening financial intermediation programs to enhance inclusion and entrepreneurship. Mr. Speaker, the macroeconomic environment has changed significantly since the 2023 budget was presented to this House in November 2022. Mr. Speaker, although pressure still exists and there are formidable risks in the horizon, our economy is in a better position than it was 7 months ago, as the macroeconomic environment has seen relative stability since the beginning of the year. This is largely explained by factors including the positive sentiments following the staff-level agreement reached in December 2022 and the subsequent approval of the 3-year, $3 billion IMF ECF program, the eventual passage of all fiscal measures in the 2023 budget by the House, and the completion of the DDEP program, and China's agreement to co-chair the OCC with France. Mr. Speaker, I have also discussed the significant improvements in the key macroeconomic indicators, including inflation, exchange rate, interest rates, reserve position, growth rate, and the performance of the bank since 2022. Mr. Speaker, all these developments, together with the need to align with the targets of the IMF-supported PC-PEC program, warrant a revision to the macroeconomic framework. This was necessary because the framework was guided by the September 2022 data that underpinned the 2023 budget in November 2022. The revisions to the macro-fiscal framework generally seek to align the 2023 mid-year fiscal review with the IMF ECF-supported PC-PEC program. Mr. Speaker, key revisions to the macro-fiscal target for 2023 year include: 1. Overall real GDP growth rate of 1.5%, down from 2.8%. Non-oil revenue GDP growth rate of 1.5%, down from 3%. End period headline inflation of 31.3% from 18.9%. Primary balance on commitment basis of a deficit of 0.5% of GDP compared to a surplus of 0.7% of GDP, aligning with IMF-supported primary balances. Gross international reserves sufficient to cover at least 0.8 months of imports of goods and services by 2023. Mr. Speaker, revisions to GDP projections. The overall real GDP growth for 2023 has been revised to 1.5% from 2.8%, and non-oil real GDP growth has also been revised to 1.5% from 3%. The downward revision in projected growth for 2023 is an indication of a broad slowdown in the three sectors of the economy as a result of factors such as the fiscal consolidation plan and difficult global conditions. Mr. Speaker, overall GDP growth is, however, projected to rebound to 2.8%, 4.7%, and 4.9% in 2024, 25, and 26, respectively. This is a result of implementation of growth-oriented and structural transformation strategies in the PC-PEC. We have, however, been charged in the PC-PEC to develop an enhanced growth strategy supported by crowding in of private, domestic, and foreign investment to further boost growth. We are confident of a private sector outlook to boost growth and jobs.
All right, so it is important we have to do this discussion on this very subject matter, and let's go on Zoom and engage the industry players. First off, the president of the Ghana Union of Traders Association, as well as the chief executive of the Ghana National Chamber of Commerce and Industry. And finally, we shall try and engage Chionam Afelu, the Greater Accra regional chairman of the AGI. First off, Mr. Mark Bedouabuaji, I would like to start off with you. Now, does the mid-year budget give you enough hope about government's intention to revive the economy, as you rightly heard from the finance minister?
Well, for me, I personally do not see anything so significant that will cause a change in the business environment as we were asking for. All the taxes that we complain about are still there. The COVID-19 tax that we asked that should be scrapped is still there. The e-levy is still at the current rate of 1%. The excise duty is still there. And then the growth and sustainability levy is still there. The VAT is still as high as almost 22%. So personally, I don't think it's going to cause any significant change in this environment. But of course, we've seen some level of stability in some areas like the exchange rate, which for me is key. So we are looking out for the next few months how things will pan out. But one important thing that I want to draw our attention to is the fact that the VAT that we have could not give us the revenue that we were expecting. Send a clear signal that this VAT is very high. Of course, it's a consumption tax. So if consumers are buying and they are consuming the product, then the VAT revenue will go up. But if the prices are such that they cannot consume because of this VAT, then definitely the VAT is not good. We have complained about the structure, the fact that close to 6% of this VAT translates into a direct cost to businesses, and that it will increase the prices of goods and services as we have experienced. So the VAT at this level, just like any other tax, when you exceed the expected level, people will find a way to avoid or evade. So we send a signal to the managers of the economy that this VAT is not good for us and they have to restructure it. We actually asked for a measure of this straight VAT and also the standard VAT and reduce it to less than 18%. And that, I think, will generate the revenue that the government wants. And we could see still a high level of risk within the economy. If you look at the revised data of GDP, about GDP from 2.8 to 1.5, non-oil from 3% to 1.5. We have also seen inflation expected to end at 31.3% from the target of 18.9. And of course, the gross international reserve of 0.8%, which is very key. It shows how fragile and weak our economy is. If you have a gross international reserve of 0.8, it means there is something significantly wrong with your economy. So the risk is still there. I mean, nothing has really changed. So businesses should continue to brace up for this difficult moment until things improve.
When you urge businesses or consumers to brace themselves up for tough times ahead, how do you mean? What exactly do you mean?
Excuse me, your line went off.
I am asking that if you say businesses or consumers should brace themselves up for tough times ahead, what exactly do you mean? Are we likely to see prices of goods being increased as a result of your disappointment in the media budget?
Well, if policy rates still remains at 30% and translating into a high cost of borrowing, if constantly we are going to see tariffs, electricity tariffs and water tariffs going up as is stated in the IMF document, we haven't seen the COVID tax being removed. We still see all these taxes around. Then definitely businesses will also react. Those that cannot absorb will definitely push some of these costs to consumers. So as I said, for me, it's just a rhetoric. Didn't see anything much as we were expecting that at least there will be some sort of clear direction on how they are going to improve the business environment, which I personally didn't see. I don't know whether my colleagues were able to pick something up, but I've gone through the entire document, but I didn't see anything that will change within the next.
Let me bring in Chiona Mapelu this very time. Chiona, did you also see something new in the budget, or you were surprised as well?
Well, thank you. Good evening, and good evening to your cherished listeners. So I would like to begin that we are fully aware that this is a mid-year review, and so essentially it's for government to match its own targets against what they plan to do beginning of the year. And so we do not necessarily expect much in terms of new taxes and so on. But what we do expect is a review of most of the taxes that have been slapped on industry downwards. Because, as we mentioned in our previous communications, these taxes are affecting our businesses in a big way. And if you listen carefully to the finance minister, he keeps on talking about industry and the growth of industry and how private sector should grow. And our belief is that the only way private sector will grow is when we receive the necessary incentives, tax reliefs, and all of this to be able to grow. So it's interesting to see on one hand that the minister really wants private sector to grow to help the economy, and the other hand, he doesn't seem to offer the needed support that we need to be able to thrive. And that's a little bit worrying. Our prayer is that we'll continue to engage the government to see how, in the shortest possible time, some of these relief can be granted to private sector. Because as Mark mentioned, it's really not easy out there. We're being tasked out of production, and it's not good, especially in the wake of the Continental Free Trade Agreement, where we are expected to produce and compete, with other African countries. And most of the competition will be around price. So if your prices are high, and mostly as a result of high tariffs, high taxes, and high interest rates and all of these, then you're out of the market. And so you may have head office of Continental Free Trade in Accra, but you may not have the full benefits that may come with that, because your prices are just high and the cost of doing business in Ghana are just so high. So overall, we do appreciate some level of stability in the macro space for some time. Really, you can see some flexibility in the exchange rates, and so on. But that is to be expected, because part of the reason that IMF program was highly pushed is so that we have stability in our macro space. And so if it is happening, then at least we're deriving the dividend. What is important is to see how this stability will be sustained over time in order to derive the gains for private sector. But to end my submission, we really feel very strongly that the government should, as a matter of necessity, consider some of these taxes. Imagine taxes on importing raw materials to manufacture sanitary pads. Sanitary pads are essential products. They are as essential as any pharmaceutical product. So on one breath, you see some of these pharmaceutical products having tax relief because of their essential nature. In another breath, sanitary pads is not receiving any of those. So we believe that some of these calls are calls that are agents that require that the government, as a matter of urgency, look at it favorably and ensure that VAT, for example, on raw materials for sanitary pads are taken up, so that together we can compete favorably in the market. Otherwise, we will have to be dealing with importation of products, and we may not be able to manufacture and grow the economy and employ the many young people that are unemployed. Thank you.
Chonam. But let me try and see if I could get in touch with Dr. Joseph Obeng. Dr. Joseph Obeng, for you, I know that before the budget review, you've had prior engagement with government on some of these concerns, especially with the taxes. And now, to your disappointment, government didn't touch on them by way of revising the taxes, as you've been calling for over the period. Now, going forward, how do you intend to survive?
Yeah, cost of doing business is going to remain until we have a revision on some of the cost of doing business, revising some of the taxes that is imposed on us. But the finance minister had actually informed us or hinted us that there were not going to be taxes and that nothing much was going to be changed on the media review, and that is just a supplementary budget, and that is going to engage with the stakeholders till the November budget, where they will factor some of our input. So we were expecting something like this. But when we talk about the budget as you read, you recall that he said that the VAT did not give the expected revenue as they are. Because the VAT as is structured now does not ensure compliance and does not ensure parity, fairness into businesses, and that it does not even help manufacturing entities. And that the whole VAT need to be restructured so that it will bring the needed compliance, and then businesses can also have the space to charge this VAT for government to have it with. Talking about the inflation and then the interest rate, he was talking, he was saying that they were going to adopt physical measures to deal that, even though they not go into the specifics. I think that we need to know the specifics so that we can also monitor everything. Because as it were now, we need um, uh, um, we need a space to grow as businesses. He was talking about growth, and if SN rate is not sustained like we are expecting, and that it is not a trend, the stability that we are enjoying is not a trend. If interest rate do not come down at the expected rate that we have to get as businesses, and then also inflation also coming down, then of course this growth that we're talking about will not happen to us.
All right.
And so we have a lot to do, especially with the coming the November budget, where our inputs should be factored.
All right.
Yeah.
Mark, so for you, you have barely 3 months to the main budget reading for next year. Now, beyond this, what are you going to do to ensure that some of these concerns are addressed? Bearing in mind, we have signed onto an IMF program, definitely, which comes with some conditionalities and policies which might not be so good for you.
Well, I think we have to continue to engage the Minister of Finance. It's important that he listens to some of our concerns, because some of the statements he made sounds contradictory. Because you want to support the private sector, you don't impose these numerous taxes on businesses. So let us look at a fine balance between how government is able to generate its revenue and also not impose a lot of taxes and cripple businesses. So we will continuously engage the Minister of Finance. I think this time around, the doors must be open. I mean, when you wait until the budget is prepared and you call us to come and listen to you, I don't think that is the approach. Prior to that, you need to engage us. You need to take our concerns on board, so that we can also feel that you are listening to us. If businesses are not taken seriously, they feel that their concerns are not factored into whatever decision we take, especially major decisions like the budget, then they will also react. If the cost increases, the cost of production increases, they will transfer this cost to consumers. You may end up not achieving the inflation target that you want to achieve. Definitely, the fiscal policy should be able to support the monetary policy, as the minister rightly said. The monetary policy on one side, for me, is doing well, but the fiscal policy is not really supporting. The complementary impact or effect is not really there. So we will continuously engage the Minister of Finance and the ministry and the major stakeholders towards ensuring that in the upcoming budget, some of the concerns we have raised regarding the taxes that we want scrapped, that regarding the high taxes that we want the rate to reduce, and also not to impose the new taxes, will be factored into the upcoming main budget. Of course, for a mid-year budget, you don't expect major significant changes in policy. As I said, it's not asking for supplementary budget. It's just a review of what has transpired since the 2023 budget was read. And clearly, the new target that were announced reflect what is on the ground, reflect the challenges that businesses and individuals are going through. If you're expecting the GDP of 1.5, then clearly you are indicating that the economy is not going to grow as much. So if we don't have to focus on what we achieved, the growth we achieved in the first quarter of 4.3, for me, that growth is not inclusive, it's not going to generate revenue. We should look at growth coming from the manufacturing sector, coming from the construction sector, and also relevant and key sectors of the economy.
All right. Thank you very much, Mark Bedu-Abuaji, for your time here on Business Live. Same applies to you, Chona Mapelu, for your time as well. And of course, Dr. Joseph for being of Guta. Pleasure having you guys on. We will continue the discussion in our subsequent bulletins. I am Pius Kojobaka. Let's get in touch on all our social media platforms on this very media budget review. Do enjoy the rest of our programs. Bye.